call of Glenmark Pharmaceuticals Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Utkarsh Gandhi, Senior General Manager, Investor Relations for Glenmark Pharmaceuticals. Thank you, and over to you, sir.
Thank you, Lizanne. Good morning, everyone, and welcome to the Q2FY26 earnings conference call of Glenmark Pharmaceuticals Limited. Before we start the call, a quick reminder to everyone that the information, statements, and analysis discussed during this call describing the company's or affiliates' objectives, projections, and estimates are forward-looking statements based on current expectations, forecasts, and assumptions, which are subject to risk and uncertainties, which could cause the actual outcomes to differ materially, and no representation or warranty, either expressed or implied, is provided in relation to this document. The company undertakes no obligation to update or revise forward-looking statements, whether because of new information, future events, or otherwise. From the management team, we have Mr. Glenn Saldanha, Chairman and Managing Director, and Mr. Anurag Mantri, Executive Director and Global CFO. Like always, I'll provide a brief update on the overall business for this quarter and then hand it over to Glenn and Anurag for their opening comments on the current and future potential of the company. Following that, we'll open the floor up for Q&A. In terms of our overall performance for the second quarter, Glenmark's consolidated revenue from operations was at rupees 60,469 million, as against rupees 34,338 million in the corresponding quarter last year, recording a YOY growth of 76%. For the 6 months ending September 30th, 2025, Glenmark's consolidated revenue was rupees 93,113 million, as against rupees 66,780 million, recording an increase of 39.4%. In terms of our regional performance, starting off with India, so sales for the formulation business for the second quarter of FY26 were rupees 1,650 million, as against rupees 12,817 million in the corresponding quarter last year, recording a decline of 87%. Glenmark has a unique legacy three-tier distribution system in India, unlike peer companies, and there was increasing uncertainty within the distribution channel following the announcement of the GST regime change on August 15th. And during the second quarter, Glenmark's primary sales were affected due to one-time reduction of distributor inventory levels, some postponement of orders, and impact of freight and reverse logistics, all in anticipation of the GST regime change. Growth was also impacted due to the base effect of the discontinued tail-end/low margin products. The company expects reported growth for India business to be in line with the secondary sales growth starting the third quarter. In terms of secondary sales growth for the second quarter, Glenmark continued to outperform the Indian pharma market. As per IQVIA, Glenmark's India formulation business recorded a growth of 10.8% in the second quarter and 11.4% as per March-September, compared to the overall market growth of 6.4% and 7.3% respectively. In terms of its core therapeutic areas, Glenmark continues to outperform the overall market as per the IQVIA secondary data. We are now ranked 13th with a market share of 2.3%. We have, in fact, now added a couple of additional brands to the IPM Top 300. We now have 11 brands in the IPM Top 300 as of March-September. And in terms of our key core therapeutic areas, we are ranked second in dermatology, third in respiratory, and fourth in the cardiac segment as per the IQVIA March-September data. In terms of some of our key launches in India, so starting off with Brukinsa. So as we had announced earlier, Glenmark had launched both these products under their Tevimbra and Brukinsa in partnership with B1 in the first quarter, and these two brands have seen a very strong uptake in the market in a short period of time as a differentiated treatment option available across multiple solid and hematological tumors. The company expects these two brands to further gain momentum and meaningfully contribute to the India business growth over the next 2-3 years. Lirafit, we continue to see strong market share in Lirafit and liraglutide market. And as announced earlier, we plan to launch other GLP-1 agonists as well. Adres, which was partnered with Pfizer, launched the product as a novel treatment for moderate to severe atopic dermatitis. Jabris has been well received by dermatologists overall. Our consumer care business recorded secondary sales of 10%. Candid powder continues to hold leading share in the market as per the IQVIA data. Our scalp portfolio delivered very strong growth during the second quarter, and some of the other direct-to-consumer brands also performed well. We recently transferred the India GCC business into a wholly owned subsidiary called Glenmark Consumer Care Limited to bring better focus to the India consumer care franchise. Moving on to North America, the North America business recorded sales of rupees 44,656 million for the second quarter as against rupees 7,405 million for the second quarter of last year. Net of the out-licensing income for ISB 2001 deal, the core business growth in North America for the second quarter was 7.4%. In the second quarter, we launched two very interesting products, micafungin injection and eribulin mesylate injection. We now have more than 10 injectable products launched in the US market and continue to build a strong institutional business franchise in the region. We are obviously leveraging our strong development capability in respiratory. We are awaiting approval for two ANDAs for the generic nasal sprays, which we have filed earlier, and as announced earlier, we have filed the ANDA for generic Flovent 44 mcg, and we are working on additional filings in the respiratory area as well. We plan to file two ANDAs in the upcoming quarter and 3 to 4 products each quarter going forward. Glenmark's marketing portfolio as of September has 53 applications pending at various stages of the approval process by Para 4. Moving on to Europe, Glenmark's Europe operations for the second quarter was at rupees 7,460 million as against rupees 6,874 million, recording a growth of 8.5%. Glenmark's European operations returned to growth in the second quarter, driven by a robust uptake of new product launches. Glenmark continued to outperform the overall pharma market in key branded markets like the Central and Eastern European countries. The Western European business also recorded double-digit growth, and branded respiratory portfolio continues to have a strong trajectory in the region. So as mentioned earlier, again, we are focused on sustaining increasing contribution from the branded markets and the branded portfolio in Europe. We now have 7 respiratory products which have been commercialized across the region, and we are awaiting launch of an additional 2-3 products over the next 18 months. Glenmark also launched Winlevi in the UK, and initial response has been very positive, and we will be launching it in other European markets as well once we get the final approval. On the emerging markets, for the second quarter of FY26, revenue from the emerging markets was rupees 6,585 million as against rupees 7,041 million, recording a decline of 6.5%. Growth in the emerging markets continued to be impacted by geopolitical uncertainties, which resulted in lower uptake in certain markets in Latin America and Middle East Africa. However, our Russia business did well. As per IQVIA MAT September data, Glenmark's Russia business recorded secondary sales growth of 8.1%. Ryaltris continues to do well in Russia and gain further share, and we continue to be ranked amongst the leading companies in dermatology and expectorant market in Russia. In Latin America, as mentioned, we witnessed some subdued secondary sales during the quarter. We have launched multiple differentiated respiratory products, including Ryaltris in markets like Mexico, and expect stronger performance in the forthcoming quarters. In Middle East Africa, also growth was impacted due to lower uptake. However, again, Ryaltris as a brand continues to do well in the region, and in other markets where it has been launched in the last few quarters, we have seen good uptake for this product. APAC region, we did well. We recorded double-digit growth during the quarter, and again, respiratory and dermatology, in both areas, we continue to perform well. Ryaltris again will keep by our partners in the forthcoming quarters. quickly giving an update on our global innovators. So Ryaltris, as mentioned, the marketing applications for Ryaltris have been filed in more than 90 markets. The product is now commercialized in 49 markets. Recently, we announced that our partner Grand Pharma had secured approval for Ryaltris in China. We are working with Grand Pharma to launch the product of the coming fiscal year. And our partner in Thailand, Organon, is also preparing to launch Ryaltris in the fourth quarter of this year. Winlevi, so as mentioned, company has launched Winlevi in the UK. We are expecting approval in other European markets as well. And as soon as we get the approval, we launch the product. Our partner Cosmo received a positive CHMP opinion in August 2025. And Winlevi is also under regulatory review in South Africa. Kinhayo, which is envafolimab, we have already filed 14 applications for Kinhayo, and first commercial launch expected towards the end of this year. We have received authorization from regulatory agencies for supply envafolimab in Kenya. We also initiated a global multi-center phase 3 trial in the neoadjuvant NSCLC setting. Trastuzumab deruxtecan. So in Q2, we announced an exclusive license and collaboration agreement with Hengrui Pharma for Trastuzumab deruxtecan, which is a next-generation HER2 targeting ADC. Glenmark has gained rights to register, develop, and commercialize the ADC in several emerging markets. This is Hengrui's self-developed HER2 targeting ADC. It was approved in China for treatment of HER2 positive non-small cell lung cancer. It is also undergoing other clinical trials in HER2 targeted solid tumors. Finally, on IGI, so quick update on the various IGI pipeline. So ISB 2001. So obviously the one big update was that post our deal announcement in July, we got the approval from the US FTC and received the upfront payment of $700 million in September. As mentioned earlier, we are eligible to receive up to $1.225 billion in development, regulatory, and commercial milestones, along with tiered double-digit net sale royalties. And Glenmark Pharma will be leading the commercialization across emerging markets. ISB 2301 is the next molecule in our IGI pipeline. This is a first-in-class multi-specific NK cell engager developed for solid tumors, and the first program from IGI's Immunite platform. The key update here is the clinical candidate was selected in October, and the program has entered IND-enabling studies. And finally, on immunology portfolio, ISB 880, which is the IL-1RAP antagonist, which was licensed to Almirall. Recently, Almirall announced that ISB 880 or LAD 191, as they call it, has moved into phase 2 studies in hidradenitis suppurativa, which is a large dermatology indication. And ISB 830 X8, which is STAR 310. This is the OX40 antagonist licensed to Astria. Recently, phase 1 trial was initiated by Astria, and they presented initial data at the European Academy of Dermatology and Venereology conference in September 2025 as a late-breaking oral presentation. Based on the initial results, the molecule looks positive in terms of its efficacy as well as safety profile, and there is potential for infrequent maintenance dosing, which is a key update there. So I think with that, I will hand it over to Glenn for his opening comments. So,
thank you, Utkarsh. Good morning, everyone. Thank you for joining the call today. I've been running Glenmark for 25 years now, and this is in fact my 100th earnings call as a listed company CEO. Since our IPO 25 years ago, Glenmark's revenues have grown more than 80 times, from 200 crores to 16,000 crores. And we have delivered phenomenal returns to our shareholders, as the stock price has gone up over 200 times during this period. Across these years, investors have always questioned our huge investment in innovation and our ability to deliver anything meaningful. In the past, to keep supporting this ambition, our operating margins and balance sheet has constantly been under stress due to high debt and other practices like high-cost pre-collections from distributors to manage our cash flows. But we knew that we were building something strong and building a strong R&D platform, so we kept going. The ISB 2001 deal clearly vindicates our years of investment in innovation. With this deal and with the receipt of 700 million to pay down all our debt and be net cash positive. We are also currently changing some of the legacy practices like pre-collection. Today, since we have surplus cash, we thought it's the best time to undo some of these practices. Additionally, we have now corrected some other anomalies in our balance sheet, which will help us improve our overall return ratios. All this will be covered by Anurag shortly. Post Q2, Glenmark is entering a new phase called Glenmark 3.0. I see Glenmark in the next 5 to 10 years as a glorious phase for the firm. We will accomplish our journey of moving up the value chain into becoming more of a branded-led company globally. In Glenmark 3.0, if I look at each of our businesses, our India business is a very strong business. We built very strong brands such as Telma, Ascoril, Candid, Alex, and we are leaders in the therapeutic areas that we operate in. We are in the top 3 in dermatology, top 3 in respiratory, top 3 in cardiovascular, and oncology continues to do well for us. Our OTC business, our in-licensed products such as Tivembra, Brukenza, and our chronic business will continue to outperform as we go forward. As per IQVIA and AVAX, we've been consistently among the fastest growing companies over the last decade as per secondary sales. Unlike our peers, we've had a legacy 3-tier distribution system. We thought we had optimal inventory in the channel. However, with the unexpected change in GST announcement in middle of October, the distributors decided to reduce their inventories due to price differentials. Today, most of inventory levels to below threshold, so you could see some restocking happening going forward. From Q3 onwards, we should get back to 1150 to 1200 crore run rate for our India business. Additionally, our India business should deliver over 4,800 crores in top-line revenues in FY27. Our US business, on the US side, our US business continues to demonstrate strong growth going forward. We look forward to our respiratory launches, our Monroe plant coming online, the in-licensed products continuing to deliver good growth, and the next 3 sole FTS/exclusive products should launch in FY27. Overall, FY27 should be a very strong year for the US business, and the growth momentum should continue post that as well. In Europe, our business continues to deliver very good results. Our respiratory launches, Ryaltris and Winlevi, should be major growth drivers for the firm going forward. Growth for the region should be in the double-digit range in the second half of this year. In emerging markets, while Q2 is an aberration, overall our emerging market business continues to be very strong. The main growth drivers in EM will be our specialty launches like Ryaltris, Envafolimab, the Hengrui HER2 that we just launched, and eventually ISB 2001. Due to this, our emerging market business should see remarkable growth going forward. If I move on to IGI, in IGI, we invested heavily over the last decade in building a world-class multi-specific antibody platform technology. This is a plug-and-play technology. The excellent ISB 2001 clinical data clearly validates that the platform works. Hence, we see all future assets coming out of this platform having a higher probability of success. Not too many companies, including oncology-focused big pharmas, have a multi-specific antibody platform technology. So this is very unique and gives us a huge competitive advantage. At IGI, we are currently running over 4 multi-specific preclinical and discovery programs that will be coming into the clinics over the next 5 years. The first is ISB 2301, which enters the clinics in FY27. IGI will keep spending around 70 to 75 million a year to bring its. Assuming these multi-specific programs work, each of them could be as valuable as ISB 2001. So out-licensing deals could be pretty big going forward from IGI. With the 3 partnered programs of ISB 2001, ISB 880 phase 2, and ISB 830 in AD, and a world-class multi-specific antibody platform technology, IGI could be amongst the most sought-after, valuable company in the next 5 to 7 years globally. Friends, in summary, post our Q2 results, I see Glenmark 3.0 as a company entering a very strong revenue growth phase of 12 to 15%, strong operating margins of 23% going forward, targeted to go up to 25+% in the years to come, a well-funded company generating strong cash flows, being zero gross debt in FY26, generating industry-best ROCs and ROEs in FY27 and beyond, excellent world-class R&D portfolio with ISB 2001, ISB 880, and a world-class multi-specific platform technology in IGI that is delivering subsequent assets like ISB 2301 and the 3 new programs, large out-licensing partnership deals over the next 5 years. In the early years, some of our previous deals were in the range of $20 to $50 million upfront because we needed the cash. Now that we have a strong balance sheet and are well funded, we are in a position to realize the full potential of the pipeline, similar to what we did with ISB 2001. IGI is being self-funded for the next 3 years. During this time, we will progress a very exciting pipeline of 2301 and 3 additional multi-specific programs in the clinics. Post 3 years, we can expect additional milestones from our partnered assets to fund IGI, potential new deals for the 4 programs that we are currently running, and possibly an IPO to raise additional funds. Hence, we will ensure that IGI continues to remain self-funded, even going beyond the 3-year mark. To conclude, our FY27 revenues we expect to be about 17,000 to 18,000 crores in terms of top-line revenues. I would now hand the floor over to Anurag to give his opening comments.
Thank you, Glenn. Good morning, everyone. As Glenn highlighted, the Glenmark 3.0 is now entering a phase of strong and sustainable growth. This will be a growth-oriented phase with a strong balance sheet and prudent capital allocation. To strengthen our balance sheet, bring in tax efficiencies, and focus on the cash flow generation, we have implemented some key changes in terms of our provisioning norms and standard operating procedures. While the one-time IGI income in this quarter would have impacted our capital ratios, the balance sheet restatement ensures that our financials represent the true capital efficiencies of our core business. Let me just outline the key changes which we have instituted in terms of our overall way of operating and the financials. So we have discontinued in the past, actually due to various operational constraints, as Glenn mentioned, we had the legacy pre-collection arrangements with the distributor across geographies. These were high-cost arrangements and as high as 20% in some cases, which adversely impacted our margins. With constraint now removed, we have discontinued these pre-collections, resulting in large increase in debtors. The transition will support improved operating margin and help us to continue a strong margin trajectory going forward. This will also help us enhance our working capital efficiencies and sustain a net working capital cycle of around 110 to 115 days, which will be in line with the peer companies despite a diversified global presence. On provisioning, we have, let me explain you the one-time provisioning and charges of debtors and inventory. We have revised our policies on debtors and inventory, and in line with the prudent accounting norms, restated certain provisions and charges to better reflect our true return ratios. These balance sheet charges are tax efficient, cash neutral, and very value accretive for the shareholders, driving improvement in key matrices such as ROCE and ROE. We are at debtors level of around 90 days and inventory level of around 80 days now, which is in line with the industry or perhaps better than the industry average in terms of inventory days, despite our geographical spread. This will help us support the growth from Q3FY26 onwards. These are provisions, and hence any recovery of debtors and inventory in the future will add to profitability. Now let me give you the cash flow reconciliation from the FB deal. So I will start from the opening cash of 31st March 2025. We had an opening cash of 1,705 crore. From ISB 2001 deal, we got around 5,950 crore. That takes us to our cash to our 7,655 crore. Then out of this, we have repaid the gross debt of 1,300 crore. We have paid the cash tax and interest, cash tax of around 75 crore and interest of around 150 crore. The capex in this H1 was around 500 crore. And then we have also paid the one-time expenses of around 650 crore. These included one-time bonus payouts to IGI team for successful execution, deal execution expenses, IP and documentation transfer charges, also the closure of the facilities in Switzerland. As you know, in these geographies, typically closing of the facilities, you have to dispense a lot of liabilities at the time of closure, which included employee-related liabilities, local. All these have been now settled with the authorities and various other miscellaneous items. And with this, the approximate then 2,874 crore was spent like this, and it includes also the legal settlement of around 200 crore, which we have actually provisioned earlier and has been now expensed out. So this includes the one provision which we made in the quarter one, if you recall, that 37.5. Out of that, almost 11 million we have repaid in this quarter, and some of the provisions of the past year we have repaid in this quarter. So this does not include any P&L charge, only cash outflow, and this is only for cash reconciliation purpose. So this adds up to 2,874 crore. Besides that, if you recall that we had because of India sales, we had a H1 business cash deficit of around 500 crore. And then that leaves us with a change in working capital of around 1,600 crore, which is primarily due to debtors and inventory. This is debtors is because of, as we said, because of the stop of pre-collection. There was an increase in debtors of around 800 crore. And similarly, inventories are actually to build up for the H2 businesses. We had to actually, and inventories, as I told you, it's still an 80 days as compared to the industry practice of 90 days. So it's all healthy inventory which we have to build up to support the growth rate of the business in H2. So that's all the change in working capital of around 1,600 crore. And that leaves us with the cash of around 2,600 crore, 2,647 to be precise. So that actually gives the full cash reconciliation. With all the above changes, we are in a very strong position and have ensured that we manage to fully express the true future potential of our business. To summarize, Glenmark 3.0 will be immediately impactful, as our EBITDA margin will trend towards 23% and strengthen further over a period of time. We will continue to maintain a strong balance sheet by sustaining zero debt and focusing on robust free cash flow generation. This will enable to maintain industry-leading return ratios of around 25 to 30% of ROCE and 20 to 25% of ROE going forward. With this, we can start the Q&A.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking my question. And again, so a couple of things. One is, clearly, this whole, the way the Q2 results came out, they were really from the corrections that were there in the P&L balance sheet were so fairly unexpected. So that's for the record. But and on this part, Glenn, you've heard your explanations, and how you see things going forward. But as an assurance, from what have you done so far? Are we done with these corrections on the legacy issues on the balance sheet and the P&L, or is this literally the end of it? If you would like to just reconfirm.
So Nitin, very clearly, if you heard my commentary, right? We are clearly in a position where we'll take each of the pieces, okay? For example, for India, we have clearly guided to 1,150-1,200 crores is starting Q3. And next year, over 4,800 crores of sales, right? So that should tell you that the India business is back on track. As far as the balance sheet changes, right? The pre-collections, we are pretty much done with everything. We've changed the model completely, right? It's clearly, I think, and the balance sheet changes is clearly reflective in our ROC and ROE, right? If you see obviously this year ROC, ROE will be very high. Next year also we'll have industry best ROCs and ROEs, right? So given all this, we are pretty much done with, and a lot of provisioning. We've made a lot of provisioning. Some of that could obviously get added back as we go forward, right? Particularly debtors and inventory. So I think from our perspective, there are no further changes in either the P&L or balance sheet corrections which need to get done going forward.
So Nitin, basically just to add to that, actually we have looked at all the provisioning norms and we have now made it on a basis of certain principles. We had a new auditor also in place, and then we discussed thoroughly with them, and we have now made a very standard process of the provisioning norms. And going forward, I can assure you that's the reason we have actually taken a one time in terms of debtors was largely because of pre-collection, and inventories are in line. So all these charges actually will help us. That balance sheet is in a very strong place and truly reflect the capital employed in the business, because that will help us to truly reflect the capital employed in the core business and improving the ROC and ROE accordingly.
Thanks. And so Glenn, just working a little bit on that. So you mentioned in your opening comments that in the past, because of investments in R&D and everything, cash flows have been a constraint for Glenmark in the past. Now with that constraint being eased, what kind of changes do you think happen? What impact does it have on the business? What flexibility does it give you for the business on a going forward basis?
So look, the way I see it, Nitin, for the journey for Glenmark, at least for the next few years, is very clearly related to continuing to be a high growth business, right? We are back in the growth phase because all these years, right, we were investing heavily in innovation, right, and we couldn't optimally invest in the base business. We are now back into a high growth phase as an organization, and I anticipate my aim is to grow this business around 15% as we go forward, right? And if you see India, for example, last month we had a 17% growth, right, which was the highest among the highest in the industry, right? So we are back into a high growth phase, right, as an organization. Our focus is to grow this business organically, so we will continue to grow organically in most of our geographies. And just by focusing on organic growth, we will get to those high growth numbers going forward, right, as an organization. And of course, free cash generation. We talked about the EBITDA margins going to 23% immediately, and then eventually we will, as the business scales, we'll go up to 25%. And then the free cash generation is a must-have, right, for us. Although we'll have zero gross debt, right, by the end of FY26. Thereafter also we will ensure that the business, will continue to generate free cash, and then we'll figure out, right, what the next steps are with the cash that gets generated by the business, from FY27 and beyond. So the journey ahead is a very different one than what we faced in the past, right? In the past, a lot of constraints came because of our high investment in innovation, right? And now that with 2001 deal happening, the cash coming in, automatically the next steps for the organization is very different, right? Where the business will throw a lot of free cash from FY27 and beyond, right? This year, of course, we are well funded, right, for this year. But FY27 and beyond, the business will throw a significant amount of free cash, right, as we go forward. On a very high EBITDA, almost 18,000 crore top line with EBITDAs of 23+%, right, will generate significant amount of free cash.
And
go ahead.
Yeah, I just build on that. So H1, I think our guidance is almost 1,800 crore EBITDA or thereabouts. So I presume, given what we've discussed so far, we should have some generation of free cash in second half of the year.
Yes, if you see that, I think we are still at a 2,700 crore of cash in the books. And as the business generates, we will surely be in a cash positive. And as Glenn mentioned, that we will be first. Our aim will be to have a completely gross debt zero by FY20 end of this March, end of this fiscal. And the business will continue to have a cash generation, and we'll have as we outlined, we'll have a very prudent capital allocation going forward to grow the business.
Thank you so much.
Thank you. The next question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, thank you for the opportunity. My first question is, you mentioned you paid around 650 crore as one-time bonus and some deal-related charges, etc. So if we see that number as a percentage of the money which you got from the deal, almost coming to 10-11%, right? So if you can explain, is this the global norm of paying such high amount to employees as an incentive, or why you have paid such a high amount? If you can just throw some light there.
So Damayanti, first of all, that 650 crores is not employee bonuses, okay? And it's not only deal cost. It combines a lot of different line items that Anurag mentioned, right? But Anurag, go ahead. Yeah.
So basically, Damayanti, it's one employee bonuses are one part, and which is in line with the biotech companies where you have to actually incentivize the R&D team and specifically to give them the continue to build the pipeline in the future. So that's absolutely in line with, and we looked at various consultants' inputs on this. And so that's one part of it. But besides that, it also includes because we run this deal and most of the quite a big pharmas, most of the big pharmas enter the data room. We set up the data room, legal charges, due diligence charges, lot of consultants were involved. So all this actually, and especially all this was actually done into the European geographies and US geographies. So which is a very high cost in terms of the lawyers and other fees. So that's also included. And also includes the LCTF closure charges, which was regulatory wise in these geographies. It's not easy to close the facilities, specifically to dispense a lot of liabilities. So it included all the settling of all the employee related liabilities, local regulatory liabilities, and everything. So this is not only that, so it's a combination of that. So with that, I think these numbers are very reasonable, I must say that.
Anurag, can you specify, as a percentage, what was the actual one-time paid, and then there are other expenses that will be, I guess, more clear?
I think because of confidentiality reasons, Damini, it's impossible to talk about specific deal bonuses or any specific line items, right, on the call.
And also, it also included the IP and documentation transfer charges, which we have also have to do as part of the transfer of this ISB 2001. So all these have been actually booked on this.
Okay. My second question is on India business. So, Glenn, again, I think we are looking for some clarity because see, GST came as a window. So, if GST change didn't happen, you wouldn't have taken this write-off, or you used this window as an opportunity to clean up the issues on distribution side. Because 2 years back also you did this inventory write-off, and at that time we thought it's like over. It's a cleaned up base to start on.
So Damayanti, if you see my opening comments, right, we thought we had an optimal inventory level in the channel, right? However, the GST thing came as an unknown, right, for us, right? It was totally unexpected, right? And then the distributors, because of the differential, right, in the GST rates, right, they started reducing their inventories, right? And today, if you see, that is all for us. Now they've reached, inventory levels which are below the threshold, right? And you could see some amount of restocking. But this was completely unexpected from our side, right? So,
but Glenn, if I may interrupt, I think this discussion on GST, etc., has been going on for some time, right? And I believe industry is also involved as a part of discussion.
But Glenmark has a unique distribution model, okay? We have a 3-tier legacy distribution model. Most of the industry is already on CNF, okay? They have CNF. So that is making the big difference, okay? Right? Because of the 3-tier distribution system that we have. And that is what is has impacted us. And it's not impacted the rest of our peers. But it's a one-time thing, as I mentioned. From Q3 onwards, you should see sales coming back. And we've even guided to 1,150-1,200 crores from Q3, as well as next year 4,800 crores and above.
Okay, just to be on same page, if you can explain what is the third layer which is additional for you against.
So we have a super stockist structure, okay, which is, we have super stockists or distributors, right? Most of the other companies have a CNS model where the inventory and everything is on the company, right? So inventory and receivable collection from stockist is on the company, whereas for us, when we do the billing, the inventory is on the distributor and his responsibility to collect from the channel. So that's the uniqueness of the model.
Okay. I'll get back in the queue. I have a few more questions. Thank you.
Thank you. The next question is from the line of Kunal Randeria from Axis Capital. Please go ahead.
Yeah, good morning, everyone. So firstly, again on the India business, Glenn, in Q3 FY24, you had undergone some kind of restructuring, and now we have this restructuring again Q2 26. So do you mind telling us what the difference was? And the extension to this question is, since you still have a 3-tier distribution structure, in future, if there are some changes from the government and or from the industry's end, do you run a risk of something similar happening?
So Kunal, I explained what currently happened, right? In terms of the future, look, the distributor inventories are now at very low levels, right? So automatically, in fact, we are expecting some restocking. Now, in future, if there is any other change that happens, it's impossible to predict, right? But I don't think in the future we will be at a disadvantage because of the 3-tier system. So that is pretty clear for us, right, as of now, right, whatever we can see. Because the inventory levels have come down to very low levels now.
All right, but then again in Q3 FY24 also, I think there was some intention of getting the inventory down, right, if I'm not wrong?
That's correct. So that was an inventory, we reduced the...
Yeah, so Kunal, actually at that point, I think we explained that, what we did is we basically consolidated some of our stock points because while we had the 3-tier system, we actually had, over a period of time, we had built some inefficiencies in terms of how many number of stock points we had across the country. And we just thought we will consolidate some of that business. And so that was a change that happened in Q3, 18-24 months back. I think what has happened this time, Glenn has explained, and I think we spoke about the future as well.
Right. Okay. Okay. And my second question, again, I think Anurag did explain the 1,650 crores of working capital, that's gone in the cash flow statement. But, to be honest, I can't really see it in the cash flow or the balance sheet. So my question is, if your inventories have now gone down, how is 1,650 if you can kind of split it between receipts? Because I think some payables would have also, gone up, or what if you just can give the split?
So, Kunal, if you see that there was inventory gone up by around 250 crore on the face of the balance sheet, and debtors was close to 400 crore on the face of the balance sheet. But the underlying towards that is that we stopped the pre-collection, so that has actually increased the 800 crore of the debtor. So that's what the reconciliation. And inventory levels also, it's all, we'll have to, as a going concern business, we'll have to keep building the inventories for the next H2 of the, and to support the growth. So which is a normal inventory of 3,300 crore today we are carrying, which is 80 days of the, just 80 days of the inventory levels.
And Kunal, just to clarify, we can connect offline as well, but if you see the cash flow, there is part of the 700 million, right, that where we received the cash, but the P&L booking will happen in subsequent quarters. So that is sitting in other current liabilities and other non-current liabilities. So, that's why if you adjust for that in the cash flow statement, broadly you will get to the working capital increase that we are talking about. But we can talk it offline also in further.
So basically the 1,500, so if you see out of 6,000 crore gross number, is that what we received, we have booked only 4,500 crore in this P&L. So balance 1,500 crore what Utkarsh mentioned is sitting in other current liabilities. That's actually what the number is actually. So and we can give you the full reconciliation of that.
And since we've taken, when we explained the cash, we took the full cash at the start, right? The entire 5,950 crores. That's why we have to adjust. We have to take the actual cash impact for the working capital increase.
Right. And just one more if I can. You have a net cash of around 1,500-1,600 crores now. I believe you still need to pay the tax on the proceeds of this ISB payment. So, can you guide to what your number could be by the end of FY26, your net cash number?
Okay, so net cash of right now we are sitting is actually 2647 crore, exactly to be precise. And in terms of the taxation of this, we have actually really worked that very well in terms of, and we have brought down despite the three level of taxation, which is Swiss taxation, US taxation, India taxation on this money flow. We have actually brought it down to close to a $90 million of total cash outflow of the taxation. The charge will be higher, but because of various, we have worked out with the various structure of absorbing the losses in the various entities. So this has come down to almost 12 to 13% of the total deal value of a cash outflow. So that will be there, and it will be going, I think large part will be going in H2, but I think balance will be going in the next year also. And this is completely has been built up in our cash flow planning. And as Glenn mentioned, with this, we are FY26, we will be a gross debt zero, surely of that.
And also, Kunal, the business will generate significant cash will get generated in the second half, okay? Right, from the business, right? Just keep that in mind.
Expected to be much higher than H1. So I think, and as Glenn mentioned, it's almost 8,000 crore of revenue which is expected in H2. So that's actually also be a strong cash generation. So besides paying the full gross debt, we will still be a cash positive.
So you'll be cash. Got it, sir. So you will be ending with at least this amount, if not more. That should be a takeaway.
Amount, I would, Kunal, I would not say that. I think what I would guide is that our first target will be to have paid all the gross debt, and the second will be to actually support all these taxation and discharge all the liabilities in terms of that. I think it's only 2 quarters, so you have to be patient with that, but we'll still be a cash positive.
Sure, sir. Thank you.
Thank you. The next question is from the line of Tarang from Old Bridge Asset Management. Please go ahead.
Hi, good morning. Just a couple of
sorry to interrupt, Tarang. We are not able to hear you clearly.
Am I audible?
Yeah, go ahead.
Okay, perfect. Just on the India business, in terms of inventory rationalization, the channel unloading that you all have done, what is the quantum of it? Is it close to about 1,000 crores?
A little less than that, I'm guessing.
Okay.
Yeah, around
1,000. So it's almost. See, our targeted run rate, as Glenn mentioned, going forward is 1150 plus. So I think that's what if you remove the 150 crore what we have booked, so close to 1,000 and maybe little higher than 1,100 crore sort of number we could have hit this quarter.
Got it. Second, the 830 crore IGI and one-time charges line item, it doesn't include the R&D associated with IGI in Q2, right? That goes in separately.
No, it does not. It's only included the one-time charge. It does not include the running expenses of R&D.
Okay. Glenn, just, you have attributed a lot of your write-offs in this quarter and the previous quarters to your, spends on innovation. But if you look at the last 12 quarters, right, the quantum of write-offs that the business is taking, it's actually a 1:1:1:1 split between Monroe, India, Zetia, and other antitrust regulations. And the fourth one would perhaps be related to your intangibles or your R&D spends. Okay. The question really is, and if you add them up, the quantum is pretty significant, and we can take the numbers offline. But really the idea here is to look forward and try to get a sense on, what are the kind of controls that you've instituted within the organization. And this is, this is not addressed specifically only to Glenn. It's really everyone who's listening to the call, the top management, the board, the CFO rather, right? This can't keep happening, Monroe, litigation, India, and obviously the R&D's, the IP innovation spends. So just wanted to get a sense on, how are you really foolproofing it going forward? What are the checks and balances, the controls that you're doing? Are there additional committees that are being set up? Do you have someone who's, really keeping a razor eye sight on what's really happening? Please.
So Kunal,
no, this is Tarang.
Sorry. So the first part, right? Look, many of the things you mentioned, right? We had a difficult patch as an organization, right? There's no taking that away, right? Whether it's Monroe, right? All the FDA challenges we faced, and the fact that the facility has not manufactured anything for the last 3-4 years, and we continue to have that operating expenses. Intangibles, a lot of the intangibles we were able to take certain write-downs. Zetia, we booked the revenues. Unfortunately, we had these class action lawsuits where we had to pay back a lot of things. So, these are not in anyone's control, okay? From a operational standpoint, it's impossible to predict any of these, right? Otherwise, from a overall business perspective, right, we have very strong controls in place, right? We have a lot of governance committees that are formed now to look at, the various aspects of the business. We have a great leadership team overseeing most of our businesses. But some of the 3-4 points that you mentioned are clearly, it's impossible to predict, right? The issues we faced in Monroe or the issues we faced with regards to the litigation costs that we ended up incurring. And even there, we have strong compliance committees now in place, right, to oversee some of the litigation aspects, right, to make sure we don't have those issues again. So I think as an organization, right, we've evolved significantly. But there's no taking away that the last 4-5 years, right, prior to the 2001 deal were difficult years because we got hit with a lot of different things from different areas, right? Be it litigation, be it Monroe, be it some of our other business challenges that we faced, right? And that obviously in my opening commentary itself I mentioned, led to increase in the debt level and led to increase in certain things that we had to do, right, from a cash flow perspective, right? Today we are in a very different place, okay, right? I mean, today the business is rock solid. The growth is very strong. The margin profile is strong. We are sitting on cash, and we will continue to sit on cash. We'll have no debt on the books. So there are there's a lot of strength in the underlying business, okay, today, which we struggled to keep in the past, right, or have in the past. So I think that gives us the confidence that, the next decade will look very solid for us, right, given all that we've got going. Plus, we are unique in terms of innovation. Nobody else has a pipeline that we have. Nobody else has a platform that we have globally. So I think my personal view is the next 5 to 10 years should be transformational for Glenmark. And I've been doing this 25 years now, right? It's not, and as I said in my opening comments, right, we've delivered significant returns to shareholders, 200 times when you think about it, right, since IPO, right, in terms of shareholder value creation, revenues growth. So look, we are a fundamentally very solid company, okay, right? We've had a phase, certain phases. Every organization goes through certain phases where there have been challenges, right? And unfortunately, we got hit with all this in the last 5 years. But we're now the 2001 deal and the kind of cash flows and the strength in the underlying business, right? Overall, the next 5 to 10 years should look very strong for us.
Got it. Glenn, just to retort to it, I think, like you called out, right, the last decade, so to say, for the business has been quite challenging from the point of view of the kind of deployments that you did in your innovation business. And, the longevity of this business takes time. And in some sense, ISB 2001 has been a strong reminder of the capabilities that you've created. But what's also happened in the last 3-4 years, so to say, with the business is that for reasons that are best known and for challenges and risks that are best being navigated by the business, the business has not been able to deliver on free cash flow. So while and it somehow comes back-ended with these write-offs coming through, and that's where probably our sort of concern stems from. So what's done is done, and as you have called out and the team's called out that you all are looking forward to the future, the only request here is that, if you all could create a mechanism where there is actually a some kind of tap in terms of trying to manage your free cash flows. And because as analysts tracking this business for the last 5 years at least, while you've been running it for the last 25 years, been tracking it for the last 5-6 years, these write-offs are extremely difficult for us to also evaluate the longevity of the business going forward. So sincere request, if this is something that, as much as it is under your control, obviously you're running a business, there are risks associated with running a business. But as much as it's under your control, if you could really put a needle on it, it'll be really, really helpful.
Sure.
Last question. Over the next 2-3 years, for all the cases that have been settled, the quantum of cash flows in the next 3 years would be in the ballpark of 800 to 1,000 crore. Does that number hold good, or is there an upside risk to that as well?
No, sorry. Can you repeat that? For all the cases that have been settled?
For all the litigation spends, for different cases that the business has undergone, right? Litigation spends, the cash outflow, while you'll have taken a provision for it, but you'll have cash outflows coming through, some bit of it in 26, 27, and 28. The number that I'm building in is about 800 to 1,000 crores. Is that the number, or it's significantly lower or higher? Will be helpful.
It's slightly lower than that. Okay, Taran.
Okay. Thank you. All the best, guys.
Thank you.
Thank you. The next question is on the line of Binu Patiparampil from Elara Capital. Please go ahead.
Hi. Good morning. Thanks for the cash flow reconciliation that Anurag offered at the consolidated level. Just also wanted to understand at the subsidiary level, at the IGI level. So this entire $700 million, I assume, came to IGI. And how much of it is still with IGI?
No, so IGI, as we outlined that as a capital allocation, we have said that IGI will be covered for next 3 years of their capital allocations, which is 70 million per annum. So almost 210 to 225 will be allocated to IGI. And as most of them actually has been, because IGI is a wholly owned subsidiary of Glenmark Holding. So most of that has been actually then come back as a thing, and then some of this will be because of the tax planning perspective. Some of this will be dividended out in the next year, so it will be a phased out dividend. But for IGI capital allocation, it's only 210 million to 225 million, which is allocated for them.
So out of the 700, only 210, 220 goes to IGI. The remaining came to some other entities of Glenmark. Is that right? That's my understanding, right?
That's basic. Yeah. Basically, that will flow through everything to Glenmark, and it will be parked in a treasury surpluses.
Okay. So out of the current 2,700 cash, which is on your consolidated books, almost entirely, when you say 200 million, roughly 70-80% of that is sitting on IGI books now. Is that my understanding correct?
Not IGI books, partly is but actually as of September, but then we have transferred the money into October also. Also then even if it's IGI, it's not physically sitting with IGI actually, because then it's been actually crossed, there was a intercompany debt which has been there, and because Glenmark has a better strength to earn the treasury income, so that has been now in treasury we are running as a consolidated basis. So that's how we are actually parking into treasury.
So the entire money came into Glenmark. I mean, non-IGI Glenmark entities. Is that correct? Entire 700 million then?
Yes. And so physical, fund-wise, everything, whether it's in the form of loan or the dividend or the other flow through, it's been under control of Glenmark.
Okay. And you will transfer 70 million a year to IGI for the expenses.
Right, absolutely. 35 million for this year, H2, and then 70 million every year as we committed.
Understood. And this 70 million will be fully expenses. Will it pass through P&L as well? Because that is expense which is incurred by IGI, right?
Yeah, so in P&L, you will see a revenue item of 70 million every year and corresponding expenses. So it will be neutralizing that.
Understood. Okay. Thank you very much.
Thank you. The next question is on the line of Kartik Bani from Bajaj Life. Please go ahead.
Thank you very much for allowing me to ask questions. So my question is on the product. So 4 assets that we mentioned on the multi-specific platform, are they all tri-specific antibodies? Are also various other antibody formats like bispecific, SCF-free, Fab, etc.? And the second question is about the timeline that you have mentioned, 5 years. Is this a timeline for recognition of the revenue, out-licensing revenue from these 4 assets, or is this a timeline for these preclinical assets to enter the clinical phase 1?
So when we say multi-specific, right, all these are more than tri-specific or more than tri-specific, right? So they have multiple binding sites, right, on the antibody. So this is all next generation programs that we are working on, right, which can be transformational, just as we did ISB 2001. Regarding your question on timeline, we said we will, 2301 enters the clinics next year, FY27, right, which again is a multi-specific. And then beyond that, as we go forward over the next 5 years, you'll see one by one of these assets coming into the clinics. Regarding timeline to partner, we said, we will continuously evaluate partnerships, right? And we will try and close partnerships in the next 5 years, right, as we go forward.
Okay, thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I now hand the conference over to Mr. Utkarsh Gandhi for his closing comments.
Yeah, thanks. I'll just hand it over to Glenn for his closing comments.
Yeah, thanks, Utkarsh. So just to close, right, I think, look, this is the best phase of Glenmark I have ever seen in the last 25 years. As we are making an orbital change for Glenmark, which allows us to reflect the true potential of the company. In summary, my commitments to the shareholders in Glenmark 3.0 is to aim for sales of around 15% every year with an ascent on a higher branded portfolio. On the margin side, a 23% EBITDA margin moving up to 25% in the years ahead. Focus on strong free cash flow and maintaining a zero gross debt balance sheet going forward. Improving our return on capital employed of 25 to 30% and continue to focus on improving it further as we move towards a more innovative-led driven portfolio. Strive to create world-class, cutting-edge, innovative assets that will enhance value creation for Glenmark shareholders going forward, and enhance the payout ratios with an increased free cash flow generation, which should happen in the years to come, starting FY27. With that, I want to thank you all for joining the call today. If you have any follow-on questions, feel free to contact either Utkarsh or anyone from the management, Anurag or myself.
Yeah.
Thank you very much.
Thanks, Lizanne. I think we can close the call. Thank you, everyone, for joining.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Glenmark Pharmaceuticals Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.